Hey everybody. Welcome. If you could just see, have you ever seen that picture of the duck that's so calm on the surface but paddling like crazy underneath? Well, that's kind of what we were doing today because we had some technical difficulties, but we do have Austin Palmer on, which is awesome. So we're going to be talking about, hey, has your retirement planning taken a back seat because your business is driving the train, right? So, hey, if that's the case for you, welcome to the club. That is more typical than not. And you don't have to be a business owner to get something out of this thing. Anyway, be kind to Austin. He has such thin skin. I'm just saying he's just a wallflower. Just kidding.
Hey,
Uh,
I'm becoming a pro. This is like my second one ever on a webinar. So,
I know. So, 2 out of 241. That's pretty good, man. Uh,
yeah, I mean, I told my wife I was going to just start doing Instagram in the Maldives and, posing and just, be a sensation soon.
You can make money doing that. So that might be a retirement strategy, Austin. I don't know. But
That,
hit us
you
up
know,
in the chat if you want to harass us, but go easy on Austin because we'd like to have him back on a third time at some point. And hit us up with the Q&A. Anything's fair game. We're going to try to keep this as apolitical as possible, but it's a little tough with this crew. But nonetheless, Jack, our Cliff Clavin of Interesting and Governmental Facts, is going to go ahead and take it, and then we'll pass it to Adam, and then we'll go. But Austin, I want you to be thinking about this before we pass it to Jack. I want you to be thinking about the most egregious, got caught unaware, lack of planning situation that you've ever run into with a business owner. No names, please. And I want you to think about one of the most amazing, well thought out planning situations that you've experienced with a business owner in particular. So think about those. So I'm not going to just hit you with a curveball right out of the gate. But anyway, Jack, would you please enlighten us on what's happening on Capitol Hill?
Yes. First of all, very random thought, Cliff Clavin-ish. So that plane crash that happened, was it in South Korea? It was over in Asia somewhere.
Well, there was one last night that was from Wichita,
Yeah, that
Kansas.
was horrible. I know. I've heard about that this morning, but the plane crash that happened overseas, one of my son's classmates is trained to be a pilot at Emory-Riddle, and we were down in Daytona last week, and so we took him out to dinner. And so I had lots of questions for him about a lot of things, but one of them was what happened in that plane crash. And he said, well, a couple things, that because the gear was not down,
Mm.
that they were likely trying to do a fly over, a fly around.
Uh,
And that when you get to a certain point, that and then the throttle was in full when they went through the wreckage. So
uh,
they were trying to power up, but apparently at some point you cannot outpower the gravitational pull and the momentum of the plane. And because they didn't have the gear down, which,
uh,
then it's like, okay, maybe they should have, but then that also increases the drag.
more
So
drag, right?
reduces the lift, right? And then the fact that there was a concrete barrier there was just a very, 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 very bad decision. So anyway, very random thought. Second random thing is that I'm going to wear this North Face jacket because I feel like that I'm going to hurt people's eyes if I move around too
Oh
much,
yeah,
kind of thing.
that's
But
that's amore.
I was thinking
It's
if
Italian.
anyone in the next 10 seconds can tell me what the predecessor to this, like the cool kids jacket was, that had the palettes on it and stuff like that, then I will give you a coffee card, because I was also
Uh,
thinking about that. And then let's talk about kind of more practical news, which is that the Fed decided that they are not going to adjust any the interest rate at this point. And and Adam has maybe a few comments about that as to the reasons why. But so just so you know, I pulled up. Okay, so last year there were 3 interest rate changes. It's currently the range is between 4.25% and 4.5%, which means that the mortgage rates are going to be above that. But in good news, that, according to Freddie Mac in their survey that they do, last week, the US weekly averages of 30-year fixed rate was 6.96, and the 15-year fixed rate was 6.16. So it did dip below 7%, which is not very helpful to a lot of potential home buyers or refinance people who desire refinances. So anyway, that's kind of what's going on with interest rates and what we are not going to see, at least in the near future. And then Adam, I don't know if you would like to share your perspective on the reasons why things are not going continue to go down, or maybe not. Maybe it's just an assumption that everybody knows.
Nah, I already got yelled at for that prior to the call, so I'm gonna keep my trap shut. And then Austin, our nice guest, if he's got anything to say about that, he's welcome to chime in. So I will say, the thing that I'm excited about having Austin on, he's always great to have as a panelist after his first guest appearance. But pre-election, I called him and said, "Hey, I just heard this on the radio, Austin, about how the stock market's in the crapper right now. And I just thought that I would have heard something about that, from somebody. And, it seems like I'm hearing the opposite, so what's the straight answer around the truth? And this isn't like, fake truth, but truth around public policy, who's in power, and then what actually happens in markets and their ability to influence it, positively or negatively, or take credit for it. Positively or negatively.
They all take credit for it.
Like he did great. Like I think he went back to like Carter and drill weave together for me. So
yeah, it's Carter's delayed effect.
Yeah, so I think it's one of those things where I'm sure at some point he's going to say, hey, we invest for the long term, all this stuff. It's nice to keep on rehearing that kind of message over and over. So I'm excited to shut up and listen to Austin, because he's one of my favorite guys to hear from on this topic.
Oh man, so you're teeing me up. I guess what I usually think about is the long term. We're talking to mainly business owners, and I like to joke that every 4 years, half of my clients call me saying the world's going to hell in a handbasket, right? Anytime parties change, whether it's Congress, or I guess we could say 2 years, Congress or the White House. People in this room, everybody watching, everybody but also publicly held companies, are you really going to change what you do? I mean, Adam, are you going to say, if so-and-so wins, I think we should go into being a payroll business. We're not doing tax planning and consulting anymore. We're not going to do audits. You're not going to change your business model, right? An attorney's not going to be like, gee whiz, maybe I should have been an engineer. So the Home Depots, the Walmarts, the Lowe's of the world, the Apples, the NVIDIAs, the JP Morgans, 10 years from now, they're going to still be doing what they do. They can't every 2 to 4 years flip a switch and go, we're not going to do this. Are there changes? Sure, tax policy could change, or energy policy could change. And we all have opinions on that. But I don't think, I'm going to use a big oil company. I don't think an oil company's sitting there going, well, if so-and-so wins, we better just shut down operations. No more drilling. I just don't think that's possible. And I think when you keep that perspective, it works. And so going back, I joke with folks, the market had 15-year period of essentially being flat in the late 60s through early 80s. And it ended, the Dow anyway, 1982 at roughly 1,000. And today it's up over 40,000. So in 43 years, 42 and a month, without dividends, you've got 40 some odd times your money in a diversified portfolio. And yet, I've never seen an article that said, if you just hold on, regardless of the political administration at the time, you'll probably be okay. But every month for the last 40 some odd years, I've heard, well, this is happening. This is going to make it all bad. This is happening. This is going to make it all bad. And it just hadn't been the case because companies look beyond 1 year, 2 year, 3 year, 5 years, 10 years. And to the people watching this, think about your company. Maybe you want to sell it, but maybe you're thinking generational. I just don't think you can stop doing what you're doing because the election didn't go your way.
Good point. Just so you know, we did have a whole bunch of a flurry on Jack's useless trivia on jackets.
I
I
saw that.
don't think it was I don't think it was the gentleman's club. But
That's something different. Yes.
yeah, no, I don't think so.
It was members only.
But
Yeah, that's what I was thinking.
Craig
That's
got
great.
it, and he was the first one in, and he also gave us some bonus useless info, which is interesting. The Gatlin brothers of country music fame were spokespeople for members only, evidently. So write that one down, Jack. Good job, Craig. Okay.
Jim got it too. Looks like Jim buzzed in
Well,
at the
and
same
so did
time.
Jamie, but I'm just looking at order.
Okay.
First came in
Who buzzed
Gentlemen's
in
Club,
first?
then yeah. So Craig did buzz in first. Sorry, Jim. Jim actually won multiple times, so he'll get a special seat at our 250th wedding or week anniversary coming up here in 9 weeks. But so Austin, thank you for kind of, at least calming the waters because, and it seems like, does it seem like the chop has gotten higher and lower with the political tenor in the last 12 years or so?
Yes, but I'm speculating. Is it because we've become that much more polarized, or is it because I can pick up my phone and get the equivalent of every encyclopedia within 30 seconds?
Yeah.
Breaking news, breaking news, breaking news. I mean, I can't walk out of a meeting or get off a phone call without headline,
Yeah.
headline, CNN, CNBC, Fox News telling me something. I think it's in your face more, right? If you go back to the 80s, we got the newspaper thrown in our driveway in Sumter, South Carolina, around 5 o'clock. And that was yesterday's news, printed
Yeah.
overnight. I mean, is it that I don't think anybody's that, maybe some, but I don't think we're all that much more politically motivated. I just think we're inundated with it, and it's front of mind. And
Good observation.
it's just nonstop.
Yeah, it is.
Yeah. So in your opinion,
Yeah,
Austin, what, if you just look at history of like massive market movement, wealth destruction events, I have a couple questions here. So we'll just start with like, what has been in the last 100 years, what has been a massive wealth destruction event? Like how many have they been and how big were they?
So probably the biggest would be the Depression, 1929. And if you look at the underlying, it's funny, it's history repeats itself. So I'm not going to say that ain't ever going to happen again. But the underlying fundamentals of what caused that crash were the amount of leverage, specifically margin borrowing to buy more stock. There were very few constraints. So today, if I had 100,000 and wanted to margin it, I could draw 50,000 out and invest it. So now I've borrowed 50, and then against that 50, theoretically, I could borrow 25, and then against that 25, I could borrow 12.5, and on and on and on. So there wasn't that 50% constraint back then. So when you get leveraged so much and things go wrong, that's what bankrupted people. So it was so bad that it took 11, 12 years to dig out of. So that would be the first big one. You had a period of high inflation starting with the Vietnam War, ending in 82, where essentially the market was flat. But we shouldn't say the market was flat. Dividends paid 4 or 5% back then. So you were getting a coupon then. You might not have been getting appreciation. I guess you could say the crash of 87 was a big drop at once. The market was back within 12 months. S&L crisis, market was back within 12 months. So the next big one is the financial crisis. And that wasn't individual investors being leveraged with margin. It was banks and brokerage firms being over leveraged. And the accounting rules and the banking rules and the safety measures, too big to fail, those have changed. That's not to say there's not something new that could happen that we haven't foreseen, but the two major drops were flaws in the design. And we've put things in place to prevent that from happening again. That doesn't mean the market can't drop. I'm not saying that. But the Depression took 10 or 11 years to recover. 2007, 2008 took another 2.5 years to recover. So in a longer term scheme, right, the Dow went down, I think in early 09 to around a little under 7,000, but 40 some odd now. I mean, that's 6 times your money in 17 years. Pretty decent recovery.
So then second question is that's a good perspective in the sense that, I think what you're saying is that markets can go up and down, that just happens. Like that's just the natural, hey, stuff goes up, stuff goes down, whatever. In the Great Depression, that was catastrophic because people were borrowing money to buy stuff, and now there's governors on that. So from that standpoint, are you aware of any policy decisions that have caused sort of massive long-term market correcting negatively type events? And second part of the question is, are you aware of any policy changes that the market said, thank God, we're bringing the bull run back, baby?
Specifically 07, 08. If we go back a few years, not to pick on the accounting industry, we had a problem with Enron, specifically in how their pipelines and their contracts were valued. Most would say it was fraud. That led to rules where we called it mark to market. That was a good thing. That was meant to stabilize things. But when it came to real estate, I'll try and make this example fairly easy. Banks were suddenly required to, if they were loaning me money on real estate and the value of my real estate dropped, I was required, accounting-wise, to recognize a loss. Well, I didn't have a loss. If I had $1 million property that was fully rented out and the value dropped to 600, and I suddenly had to report a $400,000 loss, but I'm fully rented and rents are going up, mark to market caused a loss. So the banks had to say, there's more at risk, those big write-downs that happen. I am going to be apolitical, but Barney Frank, if y'all remember him from Massachusetts, is a pretty bright guy. Early in the financial, the 08 stuff, September, he was on TV going, we need to change the market rules. It's causing a spiral. We're causing a spiral. whether or not people listened, he was right. Jim Cramer was essentially saying the same thing. His rant of they know nothing. Um, if you go look and people go, oh, well, Barack Obama got in office. Well, he got in office in late January, and the market continued down through about mid-March and then spiked up. Now, nothing against Barack Obama, but I don't think anything was done. They hadn't even passed the Affordable Care Act at that point. What did change is the mark-to-market rules in mid-March. Then the market recognized it, and there were no longer those forced write-offs of paper losses on publicly held companies, specifically banks and brokerage companies. And the market recognized that. And you go look at a chart, it went parabolic for a time because it didn't look like it was going to ever end. It just kept going down because when does the spiral end? I mean, it was a whirlpool. But we changed the rules. The accounting rules were changed. Congress got their stuff together, and the market repriced new information, as it usually does. So that would be the one example of a good policy, mark to market, because of the Enron thing. We want to prevent that. But there were offshoot consequences. And it showed up 6, 7 years later. We had to make another change. That's still a possibility. I would say the good news in all of that is Congress, the government, for the inefficiencies or, oh, we're going to do this or do that, when it really matters, they tend to get things done. COVID was, whether you agree with it or not, there were a lot of people who did not have the ability to work because we shut down their business.
Right.
Right, wrong, or indifferent, we had bipartisan agreement to get stimulus checks out to keep people from losing their homes and from being evicted. And we can debate whether, somebody like my father who was retired should have gotten a couple $1,000 or not. But that's at the margins. We needed to help people instantly. And you had a very divided Congress almost instantly agree to help. To me, that's the good news. When things go bad, they tend to get their act together.
Yeah.
Can I ask about a more recent event with the whole DeepSeek AI? So, Austin, I have been a proponent, and not necessarily a super vocal proponent, but in talking about how businesses can improve, and we see failures of businesses not keeping up with technology. We saw through COVID how businesses who were prepared or could get better prepared to do online ordering and have people, make the stuff and then bring it out to them. And so the whole, to go industry segment of brick and mortar businesses developed, all Uber Eats and all those things that came out of, I think, or were expedited out of COVID. But and so we are a proponent of technology, even though in the back of my mind I'm like, okay, we're getting closer to Skynet if it isn't already here, and so just the whole Terminator and everything else. But the and then there are others, our business owners that directly invest in and have invested in technology, AI kind of thing. And so when you have this what seemed to be disruptive news to the market, and in particularly, those of us who have stocks in NASDAQ and everything else, I mean, what is your perspective on that? Your perspective on what are the repercussions of that, and how other companies might rebound, or that industry might rebound, or that is this company going to dominate that industry? I don't see that possible. I think that maybe they have a leg up. But so anyway, again, that's from my amateur investor perspective. But thoughts on that current event?
So do you mean on the market as a whole, or like to a specific portfolio? So if you were talking about your portfolio and a segment of it went down, I would say asset allocation, how you divide your money between cash, bonds, and stocks, and diversification. Don't have all your eggs in one basket. Solve that problem.
Yeah, it
on
was
that
more of
level.
a general market kind of perspective because yeah, it's for me for the most part, I have some stuff in a generational fund, so it's like on remote control. I don't like I'm not I've said this before. I don't have the ticker going across the bottom of my screen because that would be very stressful for me. But yes, so on a more macro scale, with respect to technology and AI and how that impacts the market in general.
Um, I alluded to history can repeat itself. Internet Explorer was in the 90s, the
Mm-hmm.
thing. Pets.com got a valuation that would probably dwarf some of the Nvidias and Apples and things today. Those are no longer around. Yahoo, uh, occasionally somebody will have a Yahoo email address, but I don't think Yahoo Finance and Yahoo Games keeps up with all the other competitors out there. Market's pretty efficient. They're winners and losers. Bad banks go under. Silicon Valley Bank, eh, they took on too much risk and they paid the price. That didn't happen to a lot of banks, most banks. So when it comes to AI and all of that, history's going to repeat itself. I'm going to go back to diversification. If you ask me to throw a dart and say who's going to win, not pets.com using hindsight, but um, there are a lot of companies that you look at today that are the darlings, the seven or whatever. And I mean, from the early 2000s to the teens, it took years to recover. And I mean, I'm talking 8, 10 years, all these big name companies you could have bought at a fraction of their current price, not for a week, not like, oh, I got in there that day. I'm talking for 10 years. The Microsofts, the Apples of the world, the winners are going to be the winners, the ones that innovate. My dad owned a CPA firm. I think at its peak, it probably was less than 10% of what Adams built. And I can remember being in high school and him coming home, his partner, his main guy, and he was, damn it, James he insisted we buy this fax machine. And this is the dumbest thing I've ever heard. That was in 1987, right? I'm in college a few years later, and he's like, James rides around with a little bag in his car so he can call. Like, you can't drive 5 miles and pick up the phone or stop at a payphone. Adam, if I went back to that time and told my dad, the next you in 40 years, 30 years is going to be on a podcast, 240 some of them, talking to people who can log in from their computer. You're going to get in your car with your phone and give a little quick tidbit on, here's some things you should be thinking about at year end. Call BGW, trust us. I mean, my dad would have laughed and said, you're reading L. Ron Hubbard or some other crazy thing.
Yeah.
So, Jack, I don't know if that answers your question, but the winners win.
Yeah, it does. And I'm pulling up. So this year is our 100th year anniversary. So the firm was formed in 1925 in Toledo, Ohio. And our Charlotte office has been here since 1988. But there was, and so they're publishing things on our Facebook and other social media. And I'm going to see if I can show you when you talk about innovation. This was published and it was a workstation in our Toledo office. And as you will note, I mean, you have the monochrome display, the huge, I think that's a printer off to her left, like a dot matrix green bar, with the holes that with the pulley system kind of thing. So yes, I
Yeah.
absolutely agree that we need to the innovators are the ones that are going to win the day until Skynet takes over. So
Right.
Adam, you've raised your hand.
Yeah. So rant combined with a question, Austin. The rant is the other thing that I would like to go back and say to your dad would be, hey, by the way, every technological innovation that is made in the accounting profession will be completely destroyed by the increase of the rules and freaking regulations that we have to follow. So like, it's like we can't help ourselves, for every, hey, that's really going to game change and revolutionize the industry. I know what we'll do. We'll make yet another rule that I have to comply with. And like the latest version of that is the lease accounting standard, which is completely worthless and a total time suck, adds zero value to the financial quality of information, and absolutely destroyed any innovation that was made in the test. Rant complete. So tell him, yeah, it still takes the same freaking time to do a tax return and a financial statement as it did back in 1982. Due to that.
So just a little aside.
Yeah, I'm just giving you an example. It's like I was talking to my dad, who's an accounting professor, about this very topic because you talked about mark to market and fair value. He's like, yeah, I kind of see your point. Back in the 80s, there was maybe like 5 pages of literature on how to do fair value measurement testing in a financial statement. Now there's like thousands of pages. And at the same time, if somebody's going to commit accounting fraud, they're going to commit accounting fraud. Austin,
That's right.
1,000 pages does not make it any better than the 5 pages.
No. So I passed the CPA exam, I'm going to say 97, 98, whatever it was. And I remember my dad said, what'd you score on each of these sections? 2 of them, in all fairness, particularly auditing, bare minimum, 75, 76. And he said, I would think, you would do better than that. All right. Congratulations would have been sufficient. But I looked at him and said, well, but I had to spend a lot of time on the tax code. And he said, what do you mean? And I said, the tax code, the books that I had was this big. And then everything else was this big. When you took the exam, it was a pamphlet.
Yeah.
and you had all this other time to spend on auditing, studying. So I'm with you, Adam.
Yeah. No. So that my question is, because you hit on the pick, the winners are going to win, and we've been talking about government policy as it relates to, hey, can it influence something one way or the other? And in theory, with the tax code or government policy, the government's picking winners and losers that they're looking at. So, for example, for every Tesla that's out there, that received, government assistance, either through the form of, tax credit to subsidize the initial manufacturing run, or something else, there's as many bad stories of like, whatever, I can't remember the name of the solar company, but like whatever solar panel factory company that.
Solyndra.
Yeah, Solyndra. Right?
Oh, Solyndra, yeah.
Yeah, so I mean, like that, and that's the bad example, sir, of why we should not do government subsidies. So what if you could just kind of, if you're just a bystander, trying to hop on like winners are winners, and I'd love to be able to get in early on a winner. What are your thoughts on the subject of government policy designed to help influence the picking of a winner, and that which seems to be more industry specific, but then actually picking the winner within that industry versus these Solyndra? And I know that's a long question, but there you go.
At the risk of pretty much alienating every human alive, I'll give you 2. One for sure.
Perfect. I'm right there with
example.
you. Everybody hates me too.
And I'm trying to be apolitical about this, but okay. So recently, a week or so ago, Trump makes an announcement about we're going to invest all this money, and here's this company and this company, and they're making all this in AI and the infrastructure and all of this. And half my clients went, this is ridiculous. But the half that said that was ridiculous were thrilled when Biden did a stimulus package for the chip industry on national security grounds to move some of that out of foreign countries back in here. both policies were aimed at bringing jobs back. Now, these are two different political people, right? Trump and Biden. I mean, particularly now, we alluded to that, how polarized it's been. I'm not talking about the specifics, but the idea was bring stuff back here under the guise of helping people, higher wages, investment in us, and national security. But I could go a step further. If I hadn't alienated both sides already, right before the election, and I'm not making a judgment either way, I saw all these ads and it said, Trump's tariffs are a de facto tax on American taxpayers. I'm going to take that at its word. I'm not going to get into a debate. Those tariffs were announced in December of 2018. Trump lost in 2020. Biden took office in 2021. He expanded the tariffs. He didn't get rid of them. The tariffs were in place for all 4 years. Now, there might have been adjustments to this one or that one. But was there an ad that said, when we did tariffs, it was good because we added, 784,000 manufacturing jobs. But when he does it, it's going to be a tax on you. My point is, they're getting to the same point a lot of times. And go more specific, I think if you watch Fox News, they're going to go, look what the left screwed up. And if you watch MSNBC, they're going to say, look what the right is screwing up. And I don't know if y'all remember this. The movie or the play, Best Little Whorehouse in Texas, and Charles Durning played the sheriff. He does a little routine. I do a little sidestep. I feel like that's what I'm doing the whole time. I'm like not committing one way or the other. But I mean that. Again, I'm going to go back to everything I've said. Time is your friend. When Barack Obama won, he had both houses of Congress. Like him, hate him, doesn't matter. The American public 2 years later decided he's not going to have both houses of Congress. When Trump won, he had both houses of Congress. Within 2 years, like him, hate him, the American public said, you're not going to have both. So we talk about being polarized, and yet, to me, it's just a pendulum. And every time it seems to get too far, one way or the other, over the last 16 years, we course correct and get closer to the middle. I see no reason why that'll change. So am I worried about it? Yes. Yeah, it annoys me when we do policy that helps pick winners and losers. But again, diversification takes care of that. And time. Does that answer your question, Adam? I mean,
I think what you're basically saying is that within all of that, it would be nearly impossible to then pick the associated company winner. You know, whether you agree broadly with supporting an industry or you disagree broadly with supporting an industry, it's not like there's no magic like crystal ball in terms of like, oh, these guys are going to be good stewards of the government policy, whereas these guys are jabronis and jokers.
well, yeah, and if you want, you hear the thing, follow the money. So if we back up to the 80s, how did you own stocks? You either owned individual stocks, you paid a commission, usually 4, 5, 6%, or you were in mutual funds, which back then were 6, 7, 8% load, where you hired somebody to diversify. Things evolved and funds fees came down and they got a little more clever. But look where we are today. What is one of the fastest growing areas in terms of investments? And it's the ETFs that are, hey, low cost, it's a basket of everything. Whether you want value stocks or growth stocks, or you want to be sector specific or Jack subsector specific, AI only. All of the big players are creating these baskets for this exact reason. I think if somebody knew these are the winners and losers, and maybe they're playing that game, they'd say, put all your money on this horse. It wins every time. But instead, they're throwing money and money and money and money on, we've created a basket in this area they're probably going to be winners and losers, but the
Sure.
net result is going to be positive. Look, we can do it cheaply for you, and we're better than the next guy who's doing the same thing. And here's why. Follow the money. That's where all the big players are investing in new products to convince people like me to use for all of my clients.
Yeah.
Nobody's out there going, this is the one. With rare exception, no big players are going, this is the one. I think that's a fool's errand.
Yeah. The government's
Right?
really
Otherwise,
good.
I mean, I think everybody would own Sears and Enron and Kmart and
Fisker.
Kodak. I mean,
Fisker made a good looking car, but it was just, and they went bankrupt twice. They're out of cash again. And we put a bunch of money on them.
We
The
got a
government.
if it weren't
question.
for if it weren't for Back to the Future, would anybody remember what a DeLorean was?
Oh, yeah, right.
What
Yeah.
I was somewhere. Where was I? Somebody referred to one of the airlines, and somebody corrected them. Right? It's American Airlines now, and Charlotte's a hub. And somebody said, "Well, before that, do you remember?" And then I said, "What about Eastern?" And I mean, it was like members only. I mean, it was like the whole room went, "Oh yeah, I'd forgotten about it." They're winners and losers, but I would argue the industrial companies that make the things that go into the planes pretty much still around, regardless of the name of the airline company. Maybe
right.
this is the same thing. Follow the money.
Hey, we got a question for you, Austin, from Robert Mayetta. Good to see you here, Robert. He says, "Hey, Austin, Warren Buffett has been selling and building cash. What's your opinion of that strategy?"
That falls under the rebalance thing. He's running a lot of money. Most of his money is always invested. I mean, think about it. It's See's Candy, it's Geico, it's whatever. I don't know the Apple, Coca-Cola, whatever. In a portfolio, you need to have some amount of cash. If you look at it from a mathematical thing, just making up a number. If I need a 5% return to hit my goals, and I get a year like last year and I'm up 15 or 20 or more, short term, there tends to be a reversion to the mean. Now, that might be years before it happens, but sometimes just freeing up a little bit of cash I'm just mitigating risk. That doesn't mean I bought this stock, it doubled in 4 years. Me selling a fourth of it doesn't mean I hate the company. It just means I'm mitigating risk, and I haven't found anything yet that I want to buy to replace it. So I don't put a whole lot of stock in that. That's kind of the name of the game.
Yeah, it's kind of funny. When you say that, it's like, if I went to Las Vegas, not that I would do this, Austin, but I'm just saying for a friend, if they went to Las Vegas and they asked me for the gambling advice, when sitting at the blackjack table, I would say, when you doubled your money, first off, take enough money that you can afford to lose, which is usually, 20 times the table minimum. So then you can ride out the highs and lows. And then I would say, when you've lost half that, walk away. It's not your day, and when you've doubled that, take back your original stake and don't put it back on the table, period. you know?
That's the name of the
Right?
game.
And it's like, and that's sort of like the stock market equivalent of what you just said, which is, hey man, I don't like, I should at least consider harvesting some of the gain that I have. It's sort of like in craps, it's like, hey, I'm going to throw some money out there, but at the same time, I'm going to hedge my bet by having something on the pass line. or they don't come one.
Oh, and use roulette.
Yeah.
So everybody here takes $100 and we say, let's go have some fun. And we pick one number and one of us hits. You've got $3,000. Kudos, right? I question how many people would put that 3,000 on one number on the next spin. So why would you? I mean, and that's our fun money, right? If the 3,000 went away, other than the damn it, what's wrong with me? You're out $100. Nobody watching this, none of your clients, nobody we know is going to go bankrupt over $100. It would eat them alive if they lost the 3,000. But it's funny to me, people say, well, here's not my company, not my retirement plan, but I've amassed this cash. It's funny, investing is funny. People don't think about this. When you save money, it is a sacrifice. You didn't buy a bigger house. You didn't spoil your kids. You didn't take another trip. You didn't whatever, get a better car or any of these things. You sacrifice. For what? Hopefully for a return. What return? Hopefully one that beats inflation over time. And yet, when they do that by magnitudes, right? Inflation was 7% or 5% or 2%, whatever. But they've 10, 20, 30% multiple years. You wouldn't let the 3,000 ride. And if you did and you hit it again, you had 90,000. I don't know anybody who would say, I'm going to put the 90,000 on yet another number. And yet with their portfolio, what they sacrificed a year ago, 10 years ago, 5 years ago, and they were right about, somehow they have trouble going, I put $5,000 in this or $500,000 in this and it's worth $2 million. I don't want to get rid of it. That's just obnoxious to me. I mean, that makes no sense. And it's a winner's bias. Vegas has billion-dollar hotels built on that. And our job is to help people. The math is the same everywhere. Our job is more psychology than it is something clever. That's why I'm hesitant to say I can pick a winner. I can't. But I can read the room and go, you know why people lose a lot of money on bad stocks? Because nobody likes to admit they're wrong. If you don't believe me, if you've ever had a girlfriend or a spouse or a boyfriend or a husband, ask them their opinion of you. How well do you do at admitting you're wrong? I bet your opinion and their opinion is different. I put $10,000 in this. I really like it. My husband, my brother, my mother, my child, my spouse, we all swear by it. We love this, whatever it is, and the stock goes down in half. It usually takes somebody like me saying, cut your losses, walk away, which is exactly what you said, Adam. It's not your day.
So I want to turn the conversation a little bit to beyond just the stock market. Talk about the owner's dilemma, which is, hey, I've sacrificed everything. I've put everything on the line. I'm pouring everything into this entity. Balance sheet looks good, but I really have no liquidity. I sure hope this thing works, but that's really not necessarily like we're ignoring wealth strategy because everything is all on this one thing that I control, which that's a better bet than on stuff that I can't control. So I get it and I believe in that, but there's no balance in that at all, really. Talk about wealth planning beyond just sacrificing and pouring everything into the company. And this is kind of a jump ball for the three of you guys. Where have you seen it done poorly or not done at all, and where they suffered because of it, or on the converse, where they actually were still growing their business, betting on themselves, but also having a wealth strategy that went beyond this entity? Jump ball.
I'm going to go way back in time. This was one of my dad's, and I worked for him for a few years, summer jobs. But it was a building supply company, mom and pop, and similar to a Lowe's, Home Depot, but they specialized in local contractors. So you were 10 pieces of plywood short. Somebody like me would go deliver it to your job site. It was a very specialized thing at the time. Very successful. The estate exemption at the time, Adam, you're going to have to correct me, 650, 675, not 13 million. Okay.
Yeah.
Their son and their son-in-law worked in the business with the intent to take over. They were in their 70s, probably at the time making a couple $100,000, not the son and son-in-law, but the owners. Probably on paper, $3 million, $4 million, but $1 million of it was in inventory and $1 million of it was in the building and the land. And dating myself, family limited partnerships and stuff had been talked about, but not implemented. No shares had been gifted, no valuation discounts. All of those things were there. That was the intent. None of it was done. 72, 6 months later, the other one died. What's the estate tax bill? Millions. What's the liquidity? Few 100,000. It impaired the business for 12 years, despite the business growing. That to me is a disaster. Not that business wasn't going to be successful, but what's your intent? Are you willing to give up some of that growth, some of that investment to protect the downside? I'm sure you'll see that more than me, but that was a disaster. And it touches me because I grew up knowing these people and saw the impacts on the next two generations.
Yeah.
Yeah, and I'll throw something similar to that into the mix, which is on the legal side of things. So we have clients who spend time and money putting together this beautiful estate planning. And it may have trusts for kids and, so it stays out of the public eye and all these things. But what is not reviewed is the language in the operating agreement or the shareholders agreement. And many times that predates the estate planning, just because you get into business with people and then you have family. Sometimes, I mean, it goes the other way around as well, but the operating agreement and the shareholders agreement, depending whether it's an LLC or a corporation, tend to become static and stale. And they have certain provisions in there that may not have anticipated someone getting married, someone getting divorced, and those kind of things. Or the opposite of that, which is they do anticipate those things, but it's not commensurate or consistent with the estate planning documents. And so when we're doing estate planning, wealth strategies type work for our clients, we're very inquisitive about the governance documents of their businesses to make sure that those things do match, and that at the end of the day, if you want that ownership interest to go to your kids or to a key employee, but yet you're on the equitable distribution side of a nasty divorce, it would be nice if in that operating agreement there was a waiver of marital rights to that ownership interests that spouses have signed up for. And again, when everyone's single, it's not a big deal, but once you get married, there should be something. So what I'm saying is that a lot of times the big miss is to not go back and look at those things that you signed 10, 15 years ago when you were in a different part, different chapter of your life, in order to be consistent with the estate planning documents that you just put together to protect your minor children and other things, and that you've dealt with, in the event of divorce, that you have these things where the trust is the beneficiary of your life insurance rather than your, divorced spouse, those kind of things. So just be mindful of that, because that we see that occasionally, more often than I would hope, But, it's just because we just don't think about those things as business owners. We assume that what we drafted 15 years ago will be evergreen, and that it will be sustainable, and that it will be applicable throughout the entire run of that company.
Austin.
I'm tying all this together. It's funny, just the hypothetical. Gary, you and I start a business together, 50-50. We put up the money, we've got an idea, we've got a plan, and it starts to grow. And it's funny, it grows, it's worth more, but time goes by, we're getting older. Maybe your plan is to leave it all to a foundation. Maybe mine is to leave it to my spouse or my children or whatever. Doesn't matter. Think about this. We get married to that, well, I'm 50%. I don't want to give up 2%. I don't want to be 48 and have him 50. Doesn't that sound like, oh, I've ridden the stock to a fourfold or a tenfold? Doesn't it sound like I've ridden that roulette spin one more time, one more? It's the same story. I'm going to keep going back to this. The psychology of all of us is what interferes. So you said, Gary, you said, I don't want to talk about sacrifice. It's always sacrifice. In this case, it's a hard thing for people to hear. You have to sacrifice your pride to protect. You have to be willing to sacrifice your pride. I've won. We've won. But I want to protect that, right? The ego in me goes, here's the best stock I ever owned. Real quick anecdote. I have multiple, but one in particular. He's in his 80s. He's one of the smartest people I've ever met. He knows more than most CPAs about numbers. Andy's an engineer, but he's the most personable guy you've ever met, has an MBA, right? He's that rare combination of engineer smart and personable. And I was at his house with his spouse. And I mean, we were just cutting up, having a good time. And he said, it was a few years ago. And I know him because I know his personality because it reminds me of my dad. And he said, before you go, just a couple quick things on the portfolio. And I laughed and I said, do you want to talk about this, or this first? And I just named 3 stocks. So we're sitting in his living room. I'm on the sofa. His wife's beside me. He's in his favorite chair. And he sits up and he goes, did I email you that? I said, no. How did you know the 3 stocks I was going to pick? And I said, of the 62 positions in your portfolio, they were the only ones that were down last year. And I just had this conversation with my dad yesterday and 5 other people last week. That's pride. Nobody calls me and goes, oh, this one you picked went up 5-fold. They say, this one sucks. What's wrong with you? That's fine. I'm well compensated for that risk. I'm not fussing at all. That's fine. But again, this is all the psychology of humans. If the 4 of us build a successful business, somebody has to go, I'm willing to be 24% to achieve my goals.
Well, we can keep going
you're
on.
Sacrificing pride.
It's interesting because we've been talking almost as much about mindset, which really does matter as anything else in this whole conversation. Austin, thank you so much. We're going to have to shut her down. But for anybody that came on here late, we will be up on the BGW CPA YouTube channel later on this afternoon, and Shoemaker has the same sort of thing going on. So, Austin, thank you so much for your service. We appreciate your help. And Jack,
thank
and
you guys,
Adam,
and congratulations too. Congratulations to you guys. Y'all, I love this, and it's neat. And I think I wish my dad could see this and the efficacy of it. It's kind of cool. So, congratulations. Thank you for having me.
Thank you. Thanks for
See you,
being
Austin.
on.
Thank you.
come and
Thank you,
join us
guys.
for our
Absolutely.
250th week anniversary in 9 weeks there,
Yeah, there
Austin.
you go. See ya.
Love to.
See you guys. All right, bye.
Love to. Thank you.